Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to introduce our audience to Chris Schelling, Managing Director of Private Markets for Caprock. Chris, welcome to Philadelphia.
Thanks for having me, Rob.
Yeah, thanks for being here. And as always, Andrew O'Shea, welcome to the desk again.
Thank you. Excited to be here.
Yeah, it's exciting to have you here as well. So thanks for being here. Well, we have a lot of questions to ask you, Chris. Before we do, I'm going to read your background for the audience. Chris Schelling is an investor, advisor, and published author. During his more than 20-year tenure in the investment industry building portfolios, mostly focused on alternatives, Chris has met with over 4,000 managers and allocated roughly $7 billion, generating top quartile to top decile returns across hedge funds, real assets, private credit, and private equity. Chris is currently the managing director of private markets with Caprock. Caprock is a multifaceted wealth advisory firm that specializes in providing comprehensive investment and wealth management solutions to high net worth individuals, families, and institutional investors. Serving over 300 families, Caprock advises on now over $10 billion in assets after a recent acquisition of Gray Street, based out of Chicago, of which that $4.1 billion is allocated to private markets and $2.2 billion is deployed with impact intentionality. The firm is an SEC-registered investment advisor and a founding B Corporation headquartered in Boise, Idaho, with additional locations in Seattle, San Jose, Newport Beach, Park City, New York, and Austin, where Chris and his family are based. Chris has been active in manager research and asset allocation for 2 decades, from Mercer Investment Consulting as a senior investment associate in hedge fund manager research to the Kentucky Retirement System as deputy CIO and director of absolute and real return strategies. For over 5 years, Chris was the director of private equity with the Texas Municipal Retirement System, and more recently, the chief investment strategist with Venturi Private Wealth. Chris earned a BS degree in psychology and an MBA from the University of Illinois. Chris also earned an MS in financial markets from the Illinois Institute of Technology. Chris is also a global investor advisory board member for the Alternative Investment Management Association, an investment committee member for the Catholic Diocese of the Diocese of Austin, and 1200 VC, respectively, and finally, a CAIA Association Austin chapter executive. Chris calls the Austin area home, where he enjoys the outdoors, fitness, spending time with his family and 2 dogs, writing, reading, we're going to talk about your writing, and movies. Chris, thank you for being here. Congratulations on all your success.
Well, thank you, Rob. I appreciate that.
I usually start with the beginning, but I'm going to start with now. Where do you find all the time?
Yeah, that's a mouthful. There's a lot of words in there. I don't have a magic bullet answer for that, honestly. It's just kind of going where I feel there's value that I can create. So a lot of it is reading, researching, writing stuff that's applicable for our clients. Yeah, but it keeps me busy. That's for sure.
It sounds like it. Well, we will go a little bit back to the beginning. Yeah. We have a lot of students and educators who are now tuning into the show because, frankly speaking, manager research and due diligence aren't widely taught at most universities. So one of the questions I often get from those listeners is how did you find your way into manager research and due diligence? So where did your journey begin?
So I'll give you the short version. My undergrad is in psychology. I knew that I loved thinking about how people think and learning how they make decisions. didn't really envision a field or a career in the field of finance until I got my MBA, where I had a great professor, J.B. Kurish, who's now a dean at Emory. And he was dynamic. He really made it obvious that investments was this combination of math, which I had an aptitude for, and behavior, right? It's the behavior of market participants, and it's statistical. So, I got a job after the MBA at an asset management firm and kind of wanted to get closer to the assets. And so the journey was really wanting to learn more about how to manage money and get closer to owning the assets as opposed to kind of being an intermediary. But I also had this interest in alternative investments as being sort of the cutting edge of the asset management industry, sort of this like creative destruction of capitalism that it's occurring. Managers coming in, managers blowing up, right? New strategies evolving, and capital pursuing that. And so that just led to this evolution of getting closer to those strategies, learning more about them, and wanting to understand how they work.
I'm curious, at the time that you were studying, was there anything specific around alternatives that was being taught, or is there anything over time that you realized needed to be developed as it related to your own education?
Yeah, there really wasn't any like collegiate curriculum around alternatives as a course of study. At least not to my knowledge. The Chartered Alternative Investment Analysts Association was just being built. And so I got that designation early on, 2008, I want to say, maybe 2007. But fast forward again a few years, I designed and taught a class at the University of Kentucky on just that. It was an elective course on alternative investments because I thought it was something that I had knowledge of as a practitioner that was kind of lacking in the field from an applied perspective.
Well, you've worked on various sides of private markets over the years, venture capital, private equity, private credit. So what's equally interesting about that is you've been doing it with public pensions as well as wealth management. So how do these different aspects of private investments intersect? Yeah. And what unique insights have you gained from each of these as it relates to that kind of that crossroads?
Trying to put the whole puzzle piece, all the puzzle pieces together has been part of the journey. So let's say there's been an evolution from sort of hedge funds to more private markets in terms of my career. My first job was at an asset management firm that had long only convertible strategies and convert ARB. So they had hedge funds and registered products. I was at Mercer on the hedge fund side. At Kentucky, I ran both hedge funds and real return. So I kind of had seen what was occurring in hedge funds was this diminution of the returns. Alpha was basically disappearing. There had been a ton of capital coming into the space. First, it was kind of E&F, and then it was the larger pensions, which had bigger checks to cut. And I think it was 2006 where JP Morgan's prime brokerage team actually released a great research report about have hedge funds eroded their own opportunities. And that is clearly what had happened. I mean, you could just plot like 15-year returns up until that point, 15-year returns after that point, and they'd all been cut almost in half. And so sitting in the seat at a big pension, putting money to work, and hearing a lot of the grumbling from boards, from executive directors, from constituents that were paying fees for stuff that we're not getting risk-adjusted returns in return for, didn't want to be stuck in that vertical going forward because I was pretty convinced that returns would be muted or disappointing. And so building the real asset portfolio was when I got to dive deeper into private markets. And what I experienced was that there's just more inefficiency and more of an information advantage. I still think that persists today. It has changed and it's become more efficient, but you basically don't have data ubiquity in private markets, which means you can have an information advantage. You can have a processing advantage. On the public pension to kind of individual investor transition, I don't want to say pensions have kind of reached full allocation, but they're nearly there. I mean, 35% to private markets. That's the typical allocation for most public pensions today. E&F is even higher than that, 40, 50, depending upon how big your foundation might be. And so the next big trend for alternatives is going to be, and it's happening right now, is individual investors accessing that space in scale. And the scale is trillions of dollars.
We're going to talk more about that democratization of alternatives for the individual investor. Before we do, as of the end of the year, over half of the assets at Caprock were in alternative investments. So you have spent a significant amount of time building that portfolio prior to you joining and obviously in your role today. But for our audience who may be less familiar with Caprock, your role on the team and what your team looks like. Would you mind giving us a little bit of context?
Sure. Yeah. I mean, that was, part of the reason, or big part of the reason for joining Caprock was the belief in private markets as a driver of value creation for our clients and constituents. It's, it's preaching to the choir as opposed to trying to convert non-believers. So yeah, $4 billion plus in committed capital private markets since the inception of the firm, 18, 19 year history. And almost all of that has included allocations to private markets. To date, our team on the private market side, I would say call it 6 people full time. We're a distributed workforce, which presents its own challenges. But I think today with things like this, it becomes pretty easy to actually interact with people in all of our different offices. And that gives us a nice footprint to meet managers on the road in different spaces. So we have, pretty standard processes. We have multiple weekly calls. We have pipeline conversations. Things progress through the funnel, ultimately full IC memo and approval, and they make it into our client portfolios.
Is manager research centralized? Are you all based in Austin, or how does it work?
No, we are distributed. So we have team members in San Jose on the investment side. Obviously, in all of our cities, we have client-facing people, but we have investment people in San Jose, Boise, Seattle, which is Mercer Island. We have people in New York, and then people in Austin as well.
So taking all of those people into the process, how does that top-down process start? In terms of asset allocation, thinking about, obviously you have individual clients, so
right.
there will be bespoke needs. But if you think about some of the direction that's set as it relates to the compass of the team, right. How does that process work?
Yeah. So there's multiple things that go into it. It's not, I wouldn't say a top-down thing per se. That 30-40% allocation to private markets, that is in aggregate at the firm level. We have clients that can have none to almost 100%, depending upon their specific needs. And the advisors really help drive that asset allocation. Now, we have an investment team. We have a chief investment officer that has views on capital markets and somewhat tactical beliefs about returns. But I don't think it's a top-down push towards our advisors. Our advisors are investment professionals. And I've been spending a lot of time trying to proselytize more of the institutional approach, I'll say, where we're doing sort of a pacing. We're looking across our client portfolios. We're aggregating need for capital and saying how much money should be deployed into private markets over the next year, 2-year period, because they might have prior assets that are going to be rolling off. They might have capital that's coming in from exiting a privately held business that they own, for instance. And then we take that capital and we deploy it. So that does kind of become top down in the sense that we might know 200 million in aggregate is kind of the number that we need to fund. And then the team is out there sourcing managers in real time to kind of put that capital to work across our best ideas.
Well, I'm sure you're not alone on that soapbox.
Correct.
There are a lot of wealth managers who are doing the same thing.
Correct.
I would be interested operationally, you're coming from a pension where you're investing out of one big pool of assets. Obviously with families, that's a lot of different pools of assets. How are end clients accessing the strategies? Have you created pooled vehicles to access private investments, or are they large enough that they're just allocating individually?
It's a bit of both. I'd say that's the big difference between the individual side and the public or the institutional side is that, we have about 300 different families that we work with, and they're kind of bifurcated, right? You can think the 80-20 rule. A big chunk of the assets are with some of the larger families, and then we have, of course, some smaller families. And so the way you can service those two sets of clients is different. We do have fund of funds. I mean, we call them commingled vehicles, or think of them as a managed account solution. Mm-hmm. And so those are, we're on our 5th vintage. We'll be coming to market with that here shortly, and we target probably 100 to 150 million. Could be larger than that given our recent acquisition. And that's a way for clients really of all size to access kind of that core portfolio. And so think of that as maybe 10 to 15 kind of funds. We'll have maybe 10 co-investments underneath that, and clients can get a full allocation. If you're of such a size where that really is the entirety of your private markets portfolio, then that's what you do. When we find a manager that has capacity for the fund and additional client capacity, we will take that out to our bigger clients. And so we just closed on a fund a month ago where we had, I think, 20 checks in it. Mm-hmm. So one from our fund to fund, and then our additional clients kind of can upsize. Mm-hmm. So it's a little bit of a hybrid approach because of our client base.
And the fund of funds would be designed to be sort of your all-encompassing private solutions.
We have multiple different sleeves there as well. So we have an impact focused fund to fund. We have a real estate, real asset focused fund to fund. And then we have the private equity VC one, which is a higher cost of capital. We have not done a credit vehicle because we can access that through kind of evergreen and drawdown structures directly on client balance sheet. But that's something that we could consider too at a later date.
Mm-hmm. Take us through your typical manager underwriting process. You've identified you have $200 million that's rolling off, getting put to work. You've identified a few asset classes and dwindled it down to a handful of managers. Take us through that process in general.
It's just iterative, honestly. So we have, like I said, 6 people. All of us will be sourcing. Sourcing is kind of a 3-legged stool. We'll just get inbound, and there's a lot of inbound. I mean, I'm probably call it 25 to 50 unsolicited a day. Vast majority of those maybe don't get a lot of time because they're maybe not as good a quality as some of our targeted outbound. And then there's kind of the reference network where we'll have an LP tell us, well, you should look at this, or a client tell us you should look at this. And so those are really the 3. We have kind of a quick review where the frontline person is, looking at the material, maybe taking a quick call. And then we have what we call a prioritization process, where we have a framework to actually kind of score something that we think should be sent to the broader team to say, hey, let's get some temperature on this. What do you think? Is this worth additional work? Should it pass that process, then the lead investment professional will schedule an additional call, maybe get access to the data room and just keep working through it. So, I mean, from kind of cradle to the grave, it can take anywhere from, 6 weeks to maybe 6 months.
Are there any must-haves you have, whether it's fund size, years of experience working together? Are there just hurdles you have to get through before you'll even dive deeper?
I say one of the benefits of being on the private side is there's not hard and fast rules. On an institutional side, you may have a required minimum fund size. You may have a minimum 3-year track record. In principle, we want to see a team that has worked together. We want to see kind of some evidence of a proven track record. We want to see the required scale for you to execute on that strategy. And that can be very different. An early stage VC or a seed fund, that's going to be a smaller fund. But for a large opportunistic credit fund, it could be a little bit bigger. So we want you to have the right capital base to execute on your strategy. We've done plenty of fun ones in our history too.
Mm-hmm. That's interesting. In the bio, Robert touched on investing with impact, intentionality. Could you expand on that portfolio?
So this is not my area of expertise. We have a managing director who is, I think he is the guy, Mark Berryman, in impact. However, what I will say is what we do is we provide the tools for our clients to invest their personal portfolios according to their values. And so we have clients on both ends of the spectrum. I mean, literally as far as you can possibly get. Mm-hmm. And we're underwriting managers and co-investments that can, help them invest according to those values. I'll say we do a great job of reporting and putting metrics around that impact so they can understand whether or not it's working as well. We have proprietary tools in that space, but it's not a top-down lens where we think this is how you should do it. It's more, here's our menu. What do you believe? How can we help you invest like that?
Chris, you've been doing this a long time. So I suspect when you came to Caprock, you had a roster of managers that you've known, maybe have carried with you from firm to firm. What are some of the common traits that you've found when you're looking at managers, when you think about the must-haves or the characteristics that are consistent among those managers?
One of the biggest factors to me is the motivation of the investment team. I have a friend who once referred to, you want to make sure that they're not calling in rich. They don't get to the point where they're not incented to generate returns anymore. You can see this in all sorts of different ways. But I think that that's the clear signal that you shouldn't continue to work with them. I've used tools in the past like psych profiles. We've chatted about this, where you can kind of measure their motivation. I want a team that still has a little bit of hunger, wants to generate stronger returns, and they have their personal kind of net worth invested in the fund. But I also don't want to take, true fund one risk. So where it's a team coming together for the first time and haven't got any evidence that they've actually done this. Maybe they're spinning out from a bank and the value add could have been the flow of the seat as opposed to the team itself. So you want to make sure that risk is diffused. I kind of call it fund one upside with fund three risk. Right? Maybe it is fund two, maybe it is fund three, or maybe it's kind of a team turnover situation where it's a fund four and you can see the team that's actually had attribution for the strong deals is now assumed more of a mantle of leadership within the firm. So that's kind of the consistent theme. It's still small enough to be nimble, still young enough to be hungry, but experienced enough, and there's enough demonstrated success that your risk is a lot lower.
How do you draw the line between punishing a manager for success? For example, I worked for a manager once who, started buying racehorses. Mm-hmm. It didn't look good optically, but he was still generating alpha.
There is no clear, bright line, I have to say, and a lot of it is just experiential and it's judgment. And you're going to get it. You're going to get it wrong. I mean, you're going to re-up with a manager, and you're going to go, well, that was the time to get off the bus. I missed that one. But it's more just, I think, important to have that humility that, hey, you've got to re-underwrite, fund over fund, and not just be comfortable with, we have a great relationship with this team per se. So that's, there's certainly ones where I've wish I would have stuck with the team longer as well. Mm-hmm. Just realize that that's how it works, that motivations change. It's your job to go in and kind of see, does an incremental dollar from my clients and constituents still make sense to be put to work with these managers? Mm-hmm. And I mean, that's really what being a fiduciary is not just do it because it's easy, but is this the best use of this incremental illiquidity for my client?
You've written a lot about being a fiduciary. Specifically, you wrote a book called Better Than Alpha, which I highly recommend for our audience who are listening in. We'll put the link to look at the book if you're interested. You write about what you call organizational alpha or smart governance. So you've said you believe the best teams across really any domain do that. So, but how do you know they're the right team? So you've talked about some of the characteristics, but the team needs to come together. It's typically a collective that's making these investment decisions. So what criteria are you looking for as it relates to the team who's making the decisions?
Some of it gets back to that humility to just know when you're wrong. I've worked in teams before where, and a lot of it has to do with the trust of having worked together. Like sometimes this takes years to kind of engender this type of teamwork, but where someone can tell you you're wrong and you don't get defensive to that. So worked with an individual at Kentucky Retirement System and Texas Municipal Retirement Systems that has been probably the best person in my career to point out mistakes, whether it's a math problem or just a thesis that you got wrong, or no, the market is actually this, not that. And if you can get to that point where everyone on the team can point out each other's mistakes and it's not taken defensively, then you know that you're able to really incorporate the best ideas from the rest of the team. But I also, again, back to motivation, this is a people industry. People do two things by and large in their career. I mean, maybe in general, but in their career, definitely. They do what they get paid to do and they do what they love to do. If you can sync those two things up in your role, you're going to have success. But you can't take people and just make them do a job because you need them to do that. Some of the biggest problems I've experienced are where, well, we need you to do this. It would be like if you were my basketball coach, Rob, and you said, well, just do a 360 tomahawk dunk and go win the slam dunk contest. I've created the perfect plan. You just need to execute on it. I'm not capable of that. Like, I got to raise my hand and say I can't, but you also have to listen and say, we got to find someone else for that role. The same is true in investing. It's not all one job. There's lots of different roles. And when people are struggling in a role, it's your job as a manager to be like, this is not the right role for them. And that's a big part of managing that team.
Well, rest assured, I was an undersized forward, so I was not doing anything exciting on the basketball court. Does that tie into what you had written about intrinsic and extrinsic motivations in determining the investment outcomes? So now you've got the team, the want and the love, the intrinsic, the extrinsic. What advice do you give to investment firms aiming to optimize their team's investment performance?
Well, I mean, you can use personality profiles to actually see what people are good at and what they really want to do. But part of implementing that for our manager due diligence process, and this, not to get derailed on the subject here, but I think it's probably helpful for your audience to understand. We implemented this as Texas Municipal, found a psych profile, 45-minute online test, measures a bunch of different stuff. We gave it to 150 GPs. And what we found was that the best GPs were doing something similar either for their portfolio company execs or for their in-house teams because they wanted that same insight. How do we make decisions collectively, and how do I optimize my team performance? How do I build that smart governance, that institutional alpha, organizational alpha internally? And so I would say you can use tools to do that. Part of why we picked this tool was our team at Texas Municipal gave it to ourselves and looked at the results and said, yep, that's me, warts and all. So two great examples are I used this for a lower middle market industrial firm, and this is a firm that I have re-upped with. There's a section in there called areas of interest, and it would be similar to the aptitude tests we took in high school, like Sally's good at science or Joe should go into art or whatever. And it had all kinds of different fields, and this particular manager scored highest on like mechanical. And what he was doing was like industrial firms, and he had literally said on our on-site visit, engineer by trade, I love going in and seeing the plant floor and rolling up my sleeves. And so when I got that validation, I'm like, all right, he actually really loves what he's doing. I have more confidence that his performance will continue because work isn't a slog for him. He loves it.
I'm just curious, is character part of that assessment? Meaning, are they going to do the right thing?
Yeah.
Or, we talk about governance and, things around responsibility, ethics, virtue investing, however you want to describe it. I'm just curious if that assessment captures, why people do what they do and in the context of who they are.
So when we looked at the tests, there were components like modular that you could put into it. And so this was an aptitude, a psych profile. They also had what they had referred to as the psychopath test. And we thought probably from a partnership perspective, probably not the best way to begin a partnership by asking them to take a psychopath test. But that was measuring for things like the dark triad, Machiavellianism, narcissism, psychopathy, hopefully subclinical. And we elected not to do that, but there were components of the test that could measure whether or not you were lying, whether or not you were being truthful in your responses. And so we had that element of it. And actually, we did have one GP fail that. And the test scored his responses as not truthful. I'll say, again, anecdotally, that was a person that you always felt a little iffy. Like you felt like you were being sold all the time and just didn't completely believe them. I will say, I don't think the psych profile gives you insights that you can't get through other methods in due diligence. You can see honesty and integrity in a lot of different ways. Just a simple one is to ask the same question over the span of years. So here's where the institutional track record knowledge helps. You meet a manager and they say, we're going to do X. And then 2 years later, they do completely something different, right? That's some knowledge that you can aggregate over time. And I think it speaks to, do they do what they say they're going to do?
I love this tangent. I'm just curious, thinking about that assessment, did you consider bringing in a 360? So would you ask the GPs if you could go out, talk to their LPs, talk to their colleagues, talk to their vendors? Was there any consideration in going outside of the self-assessment into a 360 assessment?
Not using the psych profile, but I will say those references are also an important part of the process. And so we would include off-sheet references for every GP that we invested in. Most of the time, when you're looking at a fund one or a fund two, you need to verify that prior track record because it's not an audited track record with their firm. And so in so doing, you have to talk to the portfolio company executives at those companies and say, did you work with Joe and Sally or not? And they can tell you, a lot of how that team works in the real world and how they treat people. You can talk to LPs. You can talk to prior employees. I think that's probably one of the best ways. Try to triangulate through your network an employee that used to work with them at a prior firm or worked with them and have since left. You can get good references, you can get bad references, but you often get a pretty unfiltered view of how that person works.
I'm going to give my toddler the psychopath test because I have a lot of questions about her behavior recently. That's really interesting. Thank you for allowing us to go on that tangent with you. Well, your writing is prolific, and frankly, I've been following it now for a while. You have a relatively new feature that you have on your LinkedIn profile called Alternatively Speaking, and you talk about the X ratio and the I ratio as tools for assessing investment managers. So for asset managers who are listening in, could you elaborate on how you think about those two ratios, what they are, how they're applied?
Sure. Yeah. Those are both back to motivation. So if you look at from, again, the behavioral psych degree, there's two theories of motivation. There's an intrinsic theory, extrinsic theory. Extrinsic theory are external rewards, whether it's money, it's praise, it's all sorts of things. Intrinsic is the joy of doing the job. And there's lots of different ways you can look at it. We chatted, I think, about Daniel Pink's kind of book. And so those are all tied together. I wanted ways to measure those. One of the things that the psych profile was intended to do was to debias my own biases. Anytime you meet someone in person, you wind up liking them more than you did prior to the meeting. I mean, most of the time. I mean, maybe 1 out of 10, you're like, oh, they're idiots. But there's, most meetings follow a pretty well-worn script, and you walk out of there going, oh, they're smart, they're nice, or I think they're good at this. Well, how can you quantify that without just relying on your feelings? So that's where the test came in. But I found that I could measure some of those intrinsic characteristics using that aptitude sort of portion. And so we started to aggregate these numbers across team members at GPs, and we found an interesting correlation between what the teams like to do and the strategies of how they invested. And so, for instance, VCs, venture firms, scored much higher on creative interests. I mean, much, much higher. Whereas buyout firms scored much higher on financial and administrative. And if you look how they create value at their portfolio companies, it makes sense. Buyout firms create more value from optimizing balance sheet, getting smart leverage, multiple arbitrage, whereas venture firms are not just growing revenue, they're creating a product. They might even be creating a whole market. They're creating a business. And so I believe that people have a tendency to do what they love to do. And if I can actually measure, right, your self-reported interest in such a way that I can tie that to what you do on a day-to-day basis, I have more confidence that your returns are going to, in technical terms, right, conditioned upon your high intrinsic motivation score, I have more confidence in persistence of returns of that firm. On the extrinsic side, you want to see that they're aligned with making money the way you want to make money, rather than raising assets and selling. You want them to generate the return profile that you want them to generate. And so we look through their historical track record, fees from other versus fees from performance, like carry and incentive fees. And we want a specific ratio that we think is incenting them to go behave the way we want them to behave.
Interesting. Is part of that illiquidity? How does illiquidity fit into that assessment?
Yeah. So I think illiquidity itself is not a source of returns. So I've written about the illiquidity premium. I think that's a heuristic, right? That's an aggregate. What's happening is you're getting more of what drives returns in illiquid assets. So you're getting more income, you're getting more growth, you're getting more value, et cetera. And the reason you're able to is because the markets are priced in efficiency. There's wider bid-ask spreads. You can maybe cross the spread, or it's not priced accurately, but you're buying things that are cheaper. You're buying things with higher yield, and then you can make more money for having locked your capital up. So in order to ensure that we're getting enough of those returns, that's where we're doing, the real rigorous underwriting and making sure the team is in line to generate those returns for our clients' illiquidity.
Could you talk a little bit about the penalty cost approach? Yeah. So when it's been used by other institutional investors, it demands higher returns for increased commitments to illiquid investments. But could you provide more detail how this approach has worked in practice?
Yeah, MIT has a great piece from a few years ago on how they describe how it works for them. It's conceptually pretty easy. The more and more illiquid your portfolio becomes, the more you should require a higher illiquidity premium. All right, speaking out of both sides of my mouth now, illiquidity premium from your next dollar at work into an illiquid assets. And so if you're 20% private equity, right, when you bring something, it needs to be really compelling for you to make an additional commitment to get to 21 or 22%. And so maybe your required rate of return effectively has to go up for each dollar. And it's not the same for every investor. You can have, an investor that's highly liquid, very long dated, and should probably be putting more into illiquids versus someone that shouldn't be in the liquids at all. Like, I was at a pension plan that was underfunded. Our rebalancing was each month, do we sell 80 million of stocks or do we sell 80 million of bonds? And so that's got no appetite for liquidity, right? So it's different for each investor. But I think that conceptually, that's super important.
Should they be available then for individual investors? You wrote an interesting piece called The Dangerous Democratization of Alternatives on the website recently. So when you think about the potential, it's not even potential anymore, it's happening, for the democratization to change this investment landscape, how do you foresee those traditional barriers between retail and institutional investment strategies continuing to evolve? I know, Andrew, you also spend a lot of time, with your clients thinking about this shift that's going on in the market.
The barriers are falling away right now. And I'd say the flip side of that inefficiency in private markets is it's hard to understand. It's complexity. And you have broader dispersion of returns because of that inefficiency. So the better are better and the worse can be even worse. And so it's important for individual investors moving into alternatives to avoid that worst part of the spectrum. And I'd say historically, Wall Street has not necessarily done a great job of getting the best product into retail portfolios, but they've done a great job of getting product into retail portfolios. And so some of the wrappers that have been created might not be the best alignment. They might not have the greatest asset liability match, but there's others that do make sense for clients that can put money to work in private markets. I believe, this is personally my belief, that private markets offer the best risk-adjusted returns because they are less competitive. And so if you can put your capital away for 10 years, you should be investing in those asset classes. The flip side of that is, what retirement capital isn't put away for 10 years? That's the whole point. You're setting it aside for 10, 20, 30, 40 years down the road. I think the vast majority of clients should have some allocation there, but it needs to be done right.
I had one question. You talked earlier about hedge funds, and then how a lot of capital flowed into hedge funds and then the returns diminished. Is there any parallel that you foresee to that in private markets, or is it that it's such an inefficient space that there's always going to be opportunity?
There are not just parallels; it's the same thing. Like it's happening. But again, pensions are pretty close to allocation in private markets. Maybe some of them are, at 14 and want to get to 15. But by and large, that big wave has been done. And I'd see if you look to where it's happened, a big chunk of that capital has gone to big firms. Mm-hmm. So what's happening is it's bifurcating. But because of the size of private markets relative to public markets, to public capital markets, it's able to absorb that. They're multiples the size. Right? There's 7 million private businesses in the United States that have at least one employee. There's 3,500 public companies. And if you look at them at companies with 100 million in revenue or more, those are big companies. There's 200,000 private companies that size, and there's only like 2,500 publicly traded companies that size. So it's just a deeper market. It can absorb that capital. But to my point, what is happening is that there is a little bit of bifurcation. The big are getting bigger, and they're consolidating, and they're winning. And what's happening at the lower end of the market is that hasn't changed much. Mm-hmm. Right? In market, you have about 2,000 private equity firms in any given year raising capital. 1,000 of them are pretty small. Mm-hmm. There's, I want to say 500 that have less than $250 million on the cover of their fund, meaning they're raising a very small fund. That only raises 1% of the capital that's raised. So if they have 500 million or billion or 800 billion that is deployed into capital, to funds each year, a tiny percentage of it is going to that segment of the market. And so that market's not changing much. It looks like private equity did 40 or 50 years ago. Right? So you have to understand that private markets aren't one monolithic thing. Where are the capital flows going? Where's the evolution happening? And where are the returns still able to be accessed like they were?
What does that education process look like for your clients then? We've talked about kind of this institutionalization of, of the retail market, if you will. So what does that education process look like? Getting them to understand the concepts, the strategies, the illiquidity, the potential for compressed returns, lower return expectations. So how does it all come together?
Yeah, it's hand-to-hand combat. It's a lot of writing, right? It's little white papers, it's blog pieces, it's creating collateral for them. We're in the process of right now a big deck that our advisors can use and kind of shorten as needed, client by client. We're on calls with clients and prospects a lot, walking them through some of those philosophies, and we might even do things more like webinars like this, where we can speak directly to multiple clients at once. But there's no short answer. It's just get out there and do it.
Chris, as you're looking at the private alternative landscape, and I'm sure it varies by client. Are there themes of opportunity or areas your team's focused at the moment in terms of sourcing?
Yeah. So two big ones. One's maybe a bit more bottoms up. One's more a bit more top down. On the top down side, we're in market with a opportunistic real estate fund / fund to fund. It'll be sort of half funds, half co-investments. Mm-hmm. This is a mix of where we're seeing opportunities from managers, from sponsors, from fundless sponsors. But it's also just a thesis that, there's a big dislocation that's just getting started in real estate. I mean, office being kind of the tip of the spear. But when interest rates go from 0 to 5, there's a lot of stress that's been created. And so we're going to deploy that capital over the next, call it, 18-ish months. We've had a couple of closes in that fund. We've got a couple of investments already in the fund. So that's a little bit more top down. I mean, like I said, it's a mix of kind of a macro perspective with where we're seeing opportunities. The more bottom up one is from a portfolio construction perspective. We're just leaning into buyout. Historically, we've been a bit more over-indexed towards VC for a number of reasons. And if I were to look at our client portfolios, I think there's more of a need for buyout currently. And within that, again, not surprising, given my prior comments, we're focusing on kind of the lower middle market. So we've got a lot of funds in the pipeline for that.
Within the opportunities you're seeing across the real estate spectrum, would you include real estate credit as part of that?
So we have real estate credit in the portfolio in a couple of different spots. I would say this particular vehicle has a specific cost of capital that's going to be very opportunistic. So it's equity. If we will do a credit strategy within that, I would call it what I like to refer to as credit for the sake of equity. So that would be like a distressed kind of opportunity where you're buying fulcrum security and owning it through a bankruptcy process because you want to own the asset for an equity return.
Right. When you look at the buyout space, for example, how do you go about sizing those manager exposures? So you talked about the supermarkets, and then you talked about the specialty shops, which is a significantly lower proportion of the overall asset base. So how do you go about sizing those allocations?
Yeah, honestly, our sizing is just pretty consistent. What we're trying to do is build a portfolio. And so we're not really making conviction bets per se. What we're doing is, all right, if we would have, say, 100 million, just for the sake of argument, and we want maybe, 10 investments because we're going to be focused on sector specialists, smaller funds that have an industrial tilt or a telecommunications tilt or a financial services or healthcare tilt. We're going to want, 8 to 10 of those. And so we're going to size them 10 to 12 million. We might maybe make a risk tilt to it. It won't be a conviction bet. It'll be if you're a little bit of a safer hand, right? More diversified portfolio, your lower loss ratio, more consistent returns. We might go $1 million or more. If you're more of a chunky portfolio, you've had more dispersed outcomes, bigger winners, a couple of losses, we might size down just a bit. But it's pretty much just an equal weighting approach.
Is that risk factor analysis something that you introduced, or is it something that's been in?
No, that's been part of the process. It's just assessing how risky the manager is and how they fit inside of the portfolio.
Well, it helps me with my question around risk management. Sure, so I appreciate that very much. Well, given your experience and success, it's a highly competitive industry, as we all know. Andrew, out on the road, raising assets, you looking at all of these managers. What advice do you typically give to young professionals who are entering the field for the first time? You get a lot of calls, you have a lot of opportunities to be able to deploy capital to really interesting managers with good stories. So what's the advice that you're giving?
It obviously depends on a lot on what they want to do and what they're good at. Back to the motivation. For those that are interested in alternatives or interested in private markets, I do think starting your career with a big institutional allocator or investment consultant firm is a very good start because you can see a lot. Those seats are expansive. You're working with big clients. You're working with big capital pools. You get access quickly to key decision makers. And you get to meet a lot of great GPs. The best advice I could give to anyone in that seat is just get your reps up. Meet as many managers as you possibly can. You don't know what good looks like until you've seen lots of good, right? A lot of mediocre and even some really bad, because then you can go, they don't do it and they're really bad. So guess those processes that these other ones do really is important. And you can do that on the institutional side because of the scale there. So it's a great place to get started at a pension, at your local university's endowment, and because you can learn a lot there.
You talked about areas that you're focused on in terms of asset class. How'd you have a bigger picture? Just as you look ahead to 2024, we're about to wrap up the first quarter of this year. There's a lot of news that's ahead of us as we look at the next 9 months. So how are you capitalizing on some of those events that are set to happen or maybe avoiding?
Yeah. So I'm going to disclaim, I'm not a macro guy, and I'm not really a capital markets guy. I'm really focused on consistently deploying into private markets because I think that's super critical. I've not seen evidence that people can be very tactical. Well, this is a bad vintage, I'm not going to deploy. If anything, hire managers that have done a good job historically of when to slow down and ramp up and exit. So we're consistent in terms of putting private capital to work across our portfolios. But my big picture belief that things are probably a little bit worse this year than they were last year. Coming into last year, I thought everyone was overly concerned with like an imminent recession. This year, I think people are overly sanguine. If you just look at risk metrics, they're kind of all extended. The Kate ratio, the Case-Shiller PE ratio is at its third all-time high. Volatility is below 13. Dispersion amongst individual stocks in the S&P is at almost an all-time low. You things like gold peaking, you have Bitcoin peaking. It just kind of feels like risk premiums are extended right now, and people are a little bit more sanguine. We are seeing clear signs of distress in credit. Maybe not distress yet, that's too strong a word, but defaults have increased. In the private side, they were at 0 for 5 years. Now they're 1 or 2%. In the syndicated bank debt market, they were at 2%. Now they're at 6%. And so we're not at like recessionary levels, but we're from being well below historical norms, we're back at that or above it, and it's trending in that direction. So I think this year could actually see some bankruptcies, some defaults, and people should be kind of prepared for that. I just have a tendency to get a little bit more concerned when everyone else is really sanguine. Yeah.
You bring up an interesting point. I talked to a lot of firms similar to yours around the country, and it's like private credit is coming up constantly, and it makes you wonder, is there too much capital going into that space? What's the opportunity set for private credit going forward?
I think similar to private equity. I mean, that's gone from 100 billion to 1.5 trillion in 10, 15 years. And a lot of that capital has been, if you just look at the AUM, 50, 60% of it is senior secured, sponsor backed direct lending strategies, the core market. Now, again, that can, I think, absorb a lot. Mm-hmm. Just look at the size of that. Okay, it's 1.5 trillion. Okay, PE's like 3.5 trillion of dry powder, right? The typical PE structure, so a buyout is 50% debt, 50% equity. So if you've got 3.5 trillion of private equity dry powder out there looking to buy companies, it's going to need 3.5 trillion of debt because that's just the equity side of it. And so your private credit industry is not even big enough to meet all that demand. Now there's bank loans, there's high yield beyond it. I think that this can continue to scale. Now, that doesn't mean there's going to be idiosyncratic credit events within there, because there are. Bain had a great research report they release every year, their global private equity report, highly recommended to students or people who want to learn about private equity. In there, they track interest coverage ratios of privately owned businesses. Last year, more than 80% of businesses had greater than 3 times interest coverage. Now it's less than 20% just 1 year later. And so the stress is happening, and I think we're going to see that, but I don't think that means private credit is done, right? This is an asset management business now. It's going to continue to scale alongside private equity, and it's got a long runway in front of it.
Thank you for sharing that. These are the episodes that I regret we put an hour cap on the conversation. So thank you for sharing all of that. Just a couple more questions for you. We're always curious, the people who impacted your career, the mentors along the way. Who were some of those folks that you mentioned a professor earlier in the conversation?
J.B. Kurish kind of got me started down this path, but I would name 2. I always name sort of the same 2. They were colleagues at Ennis Knupp, which was a consultant firm back in the day. But Keith Black was my professor at IIT. So I went back to get a master's in finance, as I was told by a colleague that MBA will make you a better analyst, but it won't make you an analyst. So I went to get the MS in finance, and Keith was a professor there. And he is He is now at RIA Intel, designing classes on alternative investments. He was at the Kaya for a number of years. He really helped me own kind of a research-driven and analytical approach on honestly, a lot of the stuff I do is like, how would a Keith approach this problem? Like, how would he go about getting information? And then the other would be TJ Carlson, who I worked for at Kentucky and Texas Municipal. And TJ is probably the best manager of investment teams. And so I learned the kind of personal side, how to work with people and think through motivation and put those puzzle pieces together on the team. So
it's wonderful. Thank you for sharing that. I'm going to ask you one more question. It's a question that a behavioral psychologist asked me. So I think it's apropos given all of the conversation. So what is a decision in your career that you're most proud of?
A decision that I'm most proud of? I don't know. I don't think there's one. I would say what's the fact that I'm most proud of, or I guess the outcome that I'm most proud of between Kentucky and Texas Municipal. The three portfolios that I worked on, the teams that we worked together to build those portfolios, we created almost $1 billion of excess return, not nominal returns. And that actually adds to the funding status, right? If you do the actuarial math, that's something like 50,000 years worth of retirement checks that my teams helped pay for at those two institutions. So that's something that I'm most proud of, because that's real world impact. I mean, those are retirees that are 63 years on average. They get a $20,000 a year pension check, and we helped secure that for them.
Chris, thank you for being here in Philadelphia. Congratulations on all your success. This was a great conversation. Andrew, as always, thank you for your questions and thank you for being here. If you want to learn more about Chris and Caprock, please visit their website at www.caprock.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. Finally, if you like what you're seeing and hearing, please be sure to like, follow, and share these episodes. We welcome your feedback as well. Chris, thank you again for joining us. Andrew, thank you as well. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.